Hey everyone, welcome back to Corporate Decoder, the place where we decode the money moves behind the headlines. Today we're diving into KKR Real Estate Finance Trust Inc., their second quarter report. And let me tell you, it tells quite a story about their financial health and market challenges. Stick around because we're going to break down exactly what these numbers mean for the company and for investors. And before we dive in, if you like getting straight to the heart of these financial reports, hit that subscribe button and join our Discord community, linked in the description below. So first off, CREF is reporting for the quarter ending June 30th, 2025. They're what's called an accelerated filer, which means they're a significant company but not quite a mega cap player. As of mid-July, they had about 65.7 million shares of common stock out there. Now, let's jump into the balance sheet. This is like a snapshot of what the company owns and owes on a specific day. Their main game is commercial real estate loans, and they have a massive portfolio, over $5.6 billion in loans they plan to hold for a while. But here's an interesting point. This amount actually went down by about $166 million from the end of last year. That tells us they're either selling off some loans or getting a lot of repayments. Now look at this, the allowance for credit losses, which is basically a pot of money set aside for loans that might not get paid back. It jumped up significantly by almost $55 million. This is a big deal. It suggests they're seeing more risk out there in their loan portfolio and are getting more cautious. They also have over $258 million in real estate they own directly. This amount also decreased slightly, which could mean they're selling off some of these properties. And here's something new, a big chunk of nearly $500 million in assets related to CMBS trusts. CMBS stands for commercial mortgage-backed securities. These are like bundles of mortgages, and the fact that it's now on their books, while last year it was zero, means they've either bought a whole new type of investment or brought a lot more of their existing business onto their main financial statements. This is a significant shift. On the flip side of their assets, they have nearly $3 billion in secured financing. Again, this number went up significantly by about $150 million. This means they're borrowing more money to fund their operations and investments. They also have over $1.4 billion in collateralized loan obligations, which have decreased by about $318 million. This could be due to repayments or restructuring of their financing. Okay, now for the big picture, the bottom line. For the first 6 months of 2025, they reported a net loss of over $34 million. Compare that to the same period last year when they actually made over $22 million. This is a huge swing, a real reversal of fortune. And remember that big jump in their allowance for credit losses. Well, that shows up here too. Their provision for credit losses nearly doubled from last year to over $74 million. This is a major factor in why they are showing a loss this year. They are anticipating more borrowers might struggle to pay them back. For every share of common stock, investors now have an earnings loss of 68 cents over the first 6 months, compared to a small gain of 17 cents last year. This is a clear sign that their profitability has taken a hit. Looking at their equity section, they have over 13 million shares of preferred stock and about 65.7 million shares of common stock outstanding. Their additional paid-in capital, which is the money investors paid above the stock's face value, decreased slightly. This might be due to share buybacks or other equity transactions. And their accumulated deficit, which is the total of all past losses, also grew larger from $370 million to over $449 million. This shows that overall the company has lost more money than it has made since its beginning. In terms of cash flow from investing activities, they received a large amount of money from loans being repaid, over $629 million in the first half of the year. That's good, as it means their loans are being paid back. However, they also put out a lot of new loans over $626 million. This means they are actively lending, which is their core business, but it also means they are using up some of that incoming cash. Financing activities show they borrowed over $1 billion in secured financing and issued more secured term loans, which is how they fund these new loans. This borrowing activity is significant, and you can see they've repaid a lot too, but the net effect is they are using more debt to finance their strategy. It's clear they're managing a large amount of debt and financing agreements, and a lot of cash is moving in and out of these accounts. Looking at their loan portfolio concentration, California is their biggest market at around 15.6% of their loans and multifamily properties make up almost half of their investments. That's a lot of exposure to one state and one property type. And remember that increased allowance for credit losses. Well, looking at their risk ratings, they have about $443 million in loans rated as 5, which they classify as impaired litnos likely. That's about 8% of their portfolio, and that's a significant chunk that's causing them to set aside more money for potential losses. When we look at how they value their investments, especially those that are harder to price, their level 3 assets, which are valued using less observable data, have also seen a big increase. This suggests a greater reliance on their own estimates for valuation. Something that's interesting is their incentive plans. They have plans that reward employees based on company performance, and that compensation is directly tied to the company's stock value. Now, when we talk about risks, KREF is exposed to a lot of them. They're actively managing credit risk, meaning the risk that borrowers won't pay. They're also dealing with interest rate risk. Higher rates can hurt them, even though they lend at floating rates, because their own borrowing costs might go up faster than their income. They also have financing risk, meaning they need to constantly secure funds for their loans. They even quantify the impact of interest rate changes, saying a 0.5% drop in rates could cost them almost $1 million in cash flow and about a cent per share. That's a pretty direct way they're telling you how sensitive they are to interest rate movements. Their debt to equity ratio is around 2 to 1. This means for every dollar of equity they have, they owe $2. It's not alarmingly high, but it has increased from last year. And when you factor in all their financing, including those collateralized loan obligations, their total leverage ratio is almost 4 to 1. That's a lot of borrowed money. On the liquidity front, they have access to about $620 million on their revolving credit line. That's good for short-term needs, but doesn't completely offset the massive amount of debt they carry. So what's the real story here? KREF is facing some serious headwinds, that big jump in their allowance for credit losses, and the resulting net loss signal that they are anticipating a tougher market for real estate loans. The increased leverage and reliance on borrowing also put them in a more vulnerable position if market conditions worsen. They are trying to manage this by buying back some of their own stock, especially when the price is low, which is a common strategy to support the stock price. As of June 30, they had about $60 million left to spend on buying back their shares. Their management and executive compensation is tied to their stock performance, which is a double-edged sword. If the stock goes up, they do well, but if it goes down, their incentive pay could be affected too. They've also put in place a pretty generous incentive plan for their managers. The company's strategy of originating loans is solid, but the current economic climate, specifically higher interest rates and a softening real estate market, especially in offices, are clearly impacting them. The increasing provision for credit losses is a direct consequence of this, and you can see it in their net loss for the period. While they have access to credit lines and unencumbered assets, they will need to navigate these challenging conditions carefully. The concentration in California and multifamily is also a point to watch. They are borrowing more to keep things moving, which is standard in this industry, but it does increase their financial risk. A large part of their future success will depend on how well they manage their loan portfolio through this downturn and how effectively they can manage their debt. Alright, that's our deep dive into KKR Real Estate Finance Trust Inc.'s latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.